Hello, hello. Welcome to our meeting. This weekly meeting that we take every week at 8 p.m. on Wednesdays. Okay. Today we're gonna talk about a topic that it's a little bit more technical. I'll try to do a better job here to make it easier for so that everyone can understand. Okay, I will avoid jargon as much as I can. And um, so, volatility risk premium is one of the variables that the RISP 500 indicator uses as an ingredient, okay, in the algorithm. So it's really, really important in that sense. Okay. Today, we're going to talk about its predictive power uh, for market direction. We're going to define what volatility risk premium is, what does it measure, how it's calculated, and then we're going to talk about uh, its prediction power for market direction. All right, I'm going to give you some examples and and some practical uses, key takeaways, and some other information that you can explore on your own to learn more about VRP. Okay, so let's get started. Okay, all right. So before we start, let's just review real quick. What's the picture of the performance of our eight strategies compared to the S&P 500? As you can see, um, the S&P 500 now it's firmly in positive territory, been going up since after the liberation date. Um, now we're the S&P 500 is at single digits at 8%. Our most of our other strategies are doing much better, and um, at a cumulative basis, the return of our other strategies are really like, oh wow, speeding like crazy. Okay. All right. So again, always good to have new people here joining us. Welcome. And again, so I just wanted to emphasize what's the goal of this club is to empower investors to accelerate wealth growth through education by maximizing return to risk ratio and outperforming the S&P 500 every year. So that's our goal. Okay. And today, again, this is going to be our topic of the day. We're going to talk about the volatility risk premium. Okay. So, as I said, the VRP is one of the secret ingredients in the recipe to produce the risk 500 indicator. All right. There's several here. All right. Those variables have been tested for years, I would say decades. All right. Some of these, of course, over time, we will notice that some of the variables will gain significance and others may lose significance. And we use a lot of statistics, a lot of math involved in the models. And, so we do recalibration of the models as well, and some of the variables may drop and some new variables may be added as we see fit. Okay. What we need is we want the risk 500 risk indicator to be as accurate as possible, so that's the goal. All right, so we want to make sure that happens, so that's why we are always testing and retesting everything. And the volatility risk premium is one of the variables, and it's one of the very important ones, I would say. Okay. All right. So, what is volatility risk premium? It's the compensation options sellers earn for selling options to protect investors against market volatility. It works just like insurance companies selling insurance policies to people, right? So from this insurance company's perspective, it pays the claims when there is some event if it's a car insurance, say your car was totaled, you need a new car. Oh, that's an event, and the insurance company will pay this compensation for your loss, right? But for that to happen, you have to pay premium to the insurance company, right? So if we bring the same analogy to the stock market, we have the put option seller, uh, which works just like insurance company. It will pay for market losses. Okay, so an investor can get protection against bear market by buying this protection from the put option seller. All right. So if he's providing the hedge to investors, he's going to receive a premium. Okay. Now, the point is, how is this premium calculated? Right. So, in the case of a insurance premium, it's basically it depends on the probability of events causing claim to be paid, right? So let's say it's a car insurance. How probable is the car to get totaled, right? What's the so health insurance, for example, how likely is for someone to use medical services and how much those services are going to cost? So that's pretty much what how the premium is calculated, right? So in the market, it's pretty much the same idea. The probability of a bear market, right? Because in a bear market, there's going to be losses to be covered. In that case, it will trigger the payment of compensation, right, to the investor, because the investor paid the premium upfront and expects that when the market goes down and investor loses money, this this losses are going to be compensated by the provider of the hedge. Okay, so the probability that we're talking about here is probability of losses, right? And there's several variables that will be input variables for to calculate this probability. And one of the most important variables is the volatility. Because think about this, if a market is very stable, right, very boring, nothing happens, the probability of that market going negative is kind of small, right? But if you have a market that's very volatile, it goes up by a lot and goes down by a lot, right? It zigzags all every day. So that means the volatility is higher, and so the probability of losing money is higher as well. Okay, because if the investor loses money, the option seller is going to lose money too, because he has to compensate for the investor's losses. All right, so that's how it works. Very well. So what is the volatility risk premium, the VRP? It is very connected to the implied volatility, as we're going to show. Okay, so what is the implied volatility? Options act like portfolio insurance contracts, and buyers are willing to pay a premium to hedge against market losses. We just said that, right? Option prices embed a built in expected profit margin for sellers, analogous to an insurance premium. Of course, remember that insurance companies, they are not charity houses, right? They're there to make a profit, right? So if they're taking your risk, and they also want to make a profit. All right. So this profit margin is going to be included in the volatility that they're going to use in the option model. Okay. So, in fact, option implied volatility, the volatility level implied by option prices, because we can go to the stock exchange, I'm sorry, the options exchange, and we can find the option prices, and we can use the same model, the same formula that calculates option prices in reverse, and get what's the level of volatility that was implied by the option prices. I mean, the price, the volatility that the option seller used to price this option. Okay. But that volatility has historically been higher than the volatility that actually materializes. Why they do that, right? We're going to show in a minute. Okay, so let's say the volatility in the market, we call it the realized volatility or actual volatility. Let's say that's 15%, right? So that's actual volatility measured in the market. Okay, but the option seller, he's not going to use this volatility to quote an option for you. He's going to use a higher number. He's going to use a, well, what we call implied volatility of 20%, for example, right? If he uses that, that's the volatility he used to quote option prices. Okay, so he's not using the real, the actual, the realized volatility that's in the market today. He's going to quote protection with a higher number. Why? Because he wants to make a profit. All right, he wants to make a profit. And there are other reasons too. For example, if the because they're in the business of selling protection to others, they are taking their risks. So that risk is an event risk. If the volatility just jumps, hey, he's got to pay a, usually a big payout, right? So he needs to protect himself. I mean, the option seller, but at the same time, he also wants to make a profit, right? So that difference is the volatility risk premium. Okay, so the name it means exactly that. It's the premium for the risk that the option seller is taking. Okay, so he wants a risk premium on the volatility, all right, that he's using. So this gap, the implied volatility exceeding subsequent realized volatility, is what we call the volatility risk premium. It represents the risk premium investors pay to offload uncertainty and reward the to option sellers for bearing that risk, right? Because there's a risk transfer here, right? The investor is going to pay a risk premium, right? It's going to be a premium plus a risk premium on top of it, which is the VRP, so that they can transfer the uncertainty, the risk, to the option sellers. And they need that extra reward to not only protect themselves against the event of losing money, but at the same time make a profit for themselves. All right. So that's the concept. All right. So what does the VRP measure? The VRP measures how much more expensive options are compared to what actual volatility turns out to be, right? Because they're pricing above what the real volatility is. Okay. So again, the implied volatility or IV is the market forecast for future volatility used for option pricing, right? And the realized volatility, RV, is the actual volatility that's observed in the market that you can measure. All right. Okay. So the VRP equals the implied volatility minus the realized volatility. The VRP is positive about 80% of the time, which means the implied volatility is above the realized volatility. Okay, this is very important. We'll have important implications. We're going to talk about that in a minute. Okay, so but VRP means options are generally overpriced relative to realized volatility. I already explained this. So why? So option sellers need to protect themselves from market crash uncertainty because they're taking all the risk, right? You're paying them a premium upfront, a fixed amount, and then they run all the risk. What if the market crash doesn't happen? Good for them because the option sellers, they got they pocketed the premium money and didn't have to pay anything out. But what if there is a market crash? Well, in that case, they will very likely have to pay an amount that exceeds the premium by a lot, right? So that's why they need to protect themselves from this market crash volatility. That's why they need to charge a little extra, and that extra is the VRP. All right. Again, the option sellers also need to make a profit over time, right? Um, even they are even themselves, they are loss averse and tend to overestimate probability of adverse events. Of course, when they are doing this calculation, they're going to make an estimation, right? What's the probability of a market crash? They also don't know. They have to estimate. So in order to protect themselves, they're going to add a little bit of fat in there, right? A little haircut so they can get a little bit more um, money in return. Okay. Another reason is that it's a demand reason, right? Investors seeking demand outnumber protection providers, right? That's why, especially when a market crash is imminent and the market sensing that, the number of investors seeking demand will vastly outnumber the number of protection providers. That's normal, right? And there is also this concept of convex payoff, right? You don't need to get into the details what this means, but just so for your information only, the investors are willing to pay a premium for assets that do well in bad times. So sometimes, like many investors want that, right? When in a moment where everything's crashing, you want an asset that's going up in price, and you can use options to do that. So that's an additional demand for this type of for options. Okay, so that will put a little more pressure, just like the previous bullet point. Demand increase a little bit the demand for it. If the demand is greater, of course, it's going to be more expensive. The protection is going to be more expensive, right? So the VRP is going to be greater. All right. Okay. How is VRP calculated? So let's take a quick look here. We start with the implied volatility from options, option pricing. Okay, like the VIX, we like to use the VIX. The VIX is based on the S&P 500. It's not a specific stock, and we use the VIX. Uh, the VIX, they already did the job for us to calculate the implied volatility of options expiring in the next 30 days or so. Okay, it's not exactly 30 days; it's a little range, um, around 30 days, and I believe it's 18 days to 28 days, something like that. I don't remember exactly, but for all purposes we can consider 30 days. Okay, so the CBOE will already calculate that implied volatility from those options and give you the number, and that number is the VIX. Okay, so it's very easy. You don't need to do the calculation. You don't need to use the formula yourself to get the implied volatility, because we already have it right there available for you. Okay, and the realized volatility you can calculate yourself. We're going to show an example in a minute. All right. But that's measured from actual market returns. Okay. All right. So when you subtract one from the other, you get the VRP. So an example, just like the other one, implied volatility 20%, realized volatility 15%. So the VRP is 20% minus 15%, which is the 5% premium. Okay. So this difference is the extra cost in terms of premium paid by option buyers for volatility protection. Okay. All right. In practice, how do we calculate the VRP? Okay. The VRP is equal to the VIX minus the actual S&P 500 volatility uh, for 20 business days. Okay, so this is what we do. You take the VIX and you're going to subtract the actual volatility that you measure within 20 business days. And how do you do this? You can to calculate the second part. It's the logarithm of those 20-day standard deviation of the S&P 500 daily change times the square root of 252. So why 20 business days? It's because we want to get the realized volatility in the last 30 days. Okay. But the VIX is a forward looking volatility for the next 30 days. Remember, right? So we want to compare oranges to oranges, right? If the VIX it's about the next 30 days, we want the second part of this equation to be on the same terms, right? Also has to be in the last 30 days, which is about 20 business days. All right, about 20 business days in general. Okay. So why the square root of 222? Where the 222 came from? 222 is the number of business days in a calendar year. Remember, the VIX measures the implied volatility of the S&P 500 for the next 30 days. However, it's expressed in annual terms. When we say 15% or 20%, we are expressing that is an annual number. So we also need to have the second part of the equation here, right? The second term also in annual terms. So that's why we multiply by the square root of 252 days. All right. So that's the reason why. And I'll give you an example here, right? So we got here day by day, right? We got the closing price of the S&P 500 every day. And what do we do here? We add a column here in Excel. We add a column here, and here is the daily change, but in logarithm terms. All right, so it's the logarithm of 6,069.89 divided by 6,002. Okay, so that's the formula, and you do this for every day. And then what you do is you're going to take let's say today is the 22nd of July. So we're going to take the last 20 readings, We're going to calculate the standard deviation of this set of numbers, right? And we're going to multiply by the square root of 222. That's it. All right. So you're going to get a number here, and that number is your VRP. Okay. Oh, I'm sorry, not the VRP. That is the second term here, is the actual volatility of the S&P 500 in the last 20 business days or trading days. Okay? And then to calculate the VRP, you just take the VIX and subtract this number that you obtain over here. Okay? Perfect. All right, so let's see how does the VRP behaved in the past. All right, so this goes as back as April 2008, right? You see the 2008 great financial crisis, what happened with it? All right, let me just show you guys some statistics, okay? So the VRP is generally positive, okay? So this black line here is zero, okay? It's centered at zero. Everything that's above the black line is positive. Everything that's below that line is negative. So it's generally positive. Remember, we said at the beginning, 80% of the time, okay? Actually, it's 83.8% of the time, all right, based on this on this database going back as far back as April 2008, okay? 83.8% of the time, it's positive, but it collapses into negative territory during market crashes. All right. So every time there's a serious market crash, some of them we are even named here for you to know. Okay. So see the coronavirus crash, it came down real quick and by a lot. All right. But it recovered very fast as well. Right. Okay. That's the 2022 bear market and the Liberation Day. Yeah, this was recently, Liberation Day. We also had this spike down, right? So this spikes here in the negative territory is what it's giving us a signal saying, hey, we're the market is crashing. All right. Okay. So the statistic is, um, it has a mean of 3.49, a medium of 4.08, minimum, the maximum value it reached was 23.36, and the minimum's minus 50.99. All right. Okay. All right. So what drives the VRP? Right. So uh, you already you already have a big clue about that, right? So the fear of market declines lead investors to overpay for protection, right? So the implied volatility is going to go higher, and the options market imbalance, more demand for hedging than selling, right? And behavioral economics, investors tend to overestimate future volatility, driving up options prices. Okay, those things all move the VRP. But in summary, the VRP persists because investors are willing to pay for perceived risk even if it's overpriced. Okay, so the investors know that there is VRP and they're more than willing to pay it. All right, because they're going to get the protection they needed. You see, investors in the market, everyone has different risk tolerances, right? People that are more aggressive can be a provider of hedging because they're gonna uh, basically they're gonna buy the risk from those who are more conservative. They don't want to run the risk. They prefer to get insurance to make sure they're not going to be um, exposed to losses, whereas the option seller is like taking the you know he's taking the pain, right? He's taking the risk, so he has to be compensated by that, and usually the investors are okay, right? Okay, now here's the point that we came here to discuss. Um, is the VRP a good predictor of market direction? Right? How VRP predicts market movement? A high VRP indicates fear in the market. Historically, this has been a contrarian bullish signal. Okay, market may be oversold and rebound. Okay, this VRP can be used as a contrarian signal. When it's low, it indicates complacency, suggesting that market risk is underpriced, potentially leading to weaker future returns or a correction. Okay, so this is a result of studies. I'm going to show you the studies that indicated that this is true. So the VRP does have prediction power. Okay. As we're going to see, it's not perfect. And there's a lot of adjustment that need to be made, but it does have some prediction power here. Okay. So the key insight is high VRP precedes strong returns, while low VRP signals caution. Okay, the low, it goes all the way to negative, right? Okay, all right, so just some examples of past cases, right? um in 2008, right, financial crisis, the VRP turned negative, as we can see here, right? As realized volatility surpassed implied volatility, right? So it went even further. Even the VRP couldn't protect the option seller. It was really, really um, uh, you know intense. Uh, COVID-19 2020, the VRP spiked, showing excessive fear. As fear subsided, the market bounced back strongly, right? Right here. And the dot com in the 2000s, early 2000s, despite strong returns, VRP remained high. That's before the crash in 2000. Okay, it's not depicted here. This graph goes as far back as April 2008. So I don't have it here to show you, but that was what happened. All right. There were studies, people, did some papers on these cases using VRP. All right. So practical uses of VRP besides giving us direction, right? So investors can use that for selling options when VRP is high. Investors can sell options to capture the high premiums. Some people do this kind of deal. Hedging also, right? When VRP is low, investors may choose to buy options to protect against future volatility. Okay. The key concept is VRP helps investors gauge market sentiment, informing decisions about whether to take on risk or hedge positions based on implied volatility. So VRP can give you is another weapon in your arsenal to help you make decisions in the market. If you are a stock investor that you never heard of VRP before, hey, so here is something, another tool for you to consider. Okay. Okay. So key takeaways on VRP. The VRP is the difference between the implied and the realized volatility. High VRP suggests fear in the market and potential for a rebound. Low VRP suggests complacency and possible future risk. Okay, so we got to be careful with those low values. VRP is a valuable predictor of future returns and market movements. So it is, right? Understanding VRP helps investors make more informed decisions in both volatile and calm market periods. Okay, so if you want to explore more about VRP, there's some resources here, some books and articles. Volatility Risk Premium: A Critical View by Tim Bolerslev, 2009 paper. Volatility Risk Premium and Asset Pricing. There's several academic papers. All right. You can also find information on the CBOE website, and there other all the literature about the VIX index. You will always find some reference to volatility risk premium, and especially the implied volatility, because the VIX index itself is an implied volatility. Okay, great. All right. Okay, so let's now compare the VRP with the RISP 500 indicator. All right, let's see how good are they at predicting and helping investors navigate the market. Okay, so on this chart here we have two graphs, right? So on the top, we have the RISP 500, okay, the indicator. I'm using here the 75 percentile as the cutoff level, RPT, right? Every time the RISP 500, the indicator went above the red line, the 75 percentile red line, right? It's a signal for the investor to be out of the market, right? So he has a risk position. He's invested in the S&P 500. Just sell it, right? And he will wait until the um, the risk 500 indicator crosses the red line below that line. Okay, when it goes below, it means that the risk measured is lower than the risk tolerance here. Okay, so for I painted these areas in pink to show the moments where it's off, right? You should be risk off, right? The white areas here means you're risk on. So risk on, risk off. There you go. Okay. So look at the what happened with the S&P 500 in the bottom chart here, right? So we have in 2022 we had a bear market pretty much, right? So the risk indicator, the risk 500 indicated, several moments that you gotta be off market, right? Especially when, look at this, what happened when this was triggered? The market was going down, this downturn over here, right? But then it went up, and the indicator also went up, right? And you can look every major dip, every major dip, we got the risk 500 indicating time to go off, like this one, for example, right? This is just I'm showing graphically, but we have all the data, in for day by day. All right, and as you can see, the major dips, all the major dips, 2025 liberation date, right? We sold here and then we bought back here, right? We sold here, we bought back here. We sold here, we bought back here, right? Okay, so it's aligned perfectly with major dips, with all the major dips. It signaled every major dip and signaled pretty early, okay? Almost at the same time. All right. So if you incur a loss, it's going to be a small loss, right? It's not going to be a big loss because it signals very quick. All right. How about the VRP? Let's say you are not using the RISP 500, but you're using VRP to do the same job. How well would it do, right? Well, let's see. If we use the zero VRP, right, all the negative numbers, when it turns negative to signal, see that it's not well aligned um, with the pink areas. You see, sometimes it it signals late, and sometimes it doesn't even signal, right? Okay, for example, this one here, late, it already happened, right? Here, this one here, right? This one late, it's already happened, right? And so on and so forth, right? So that we have several examples here. You can see for yourself. So the thing is that it often signal late and not always signal. Can the model be improved? Yes. The answer is yes. Okay. One way to do it is to place more weight on more recent data to better capture trend. Remember, when we calculated the VRP, we used the last 20 days, right? The last 20 days of volatility, right? Measured day by day for 20 days. But if we want this to go faster, to signal faster, we got to give more weight, put more weight on more recent data. Okay. Let's say the volatility of yesterday is more important than that of 20 days ago. Okay. So this is the idea. This is one way that we can make it more significant for us. There are other adjustments that we can make as well. All right. So just want to show you that the RISP 500 is a much better indicator. Why? Because the RISP, um, the the VRP is just one component of the RISP 500. RISP 500 has more than 16 variables. All right, so VRP is just one of them. Okay, we got information from multiple sources. We're looking at different things. We're measuring different variables in the market at the same time. Okay, so this is going to give us information, yes, but the other variables are going to give us very, very precious information as well. Okay, so bits of information like pieces of a puzzle for us to accurately measure what's going on in the market, and so that we can take action and quickly. All right. Okay. So this RISP 500. It This is just to show you guys how it did in the last few years, right? Since 2022, you see the 2022 was essentially a bear market, so the RISP 500 went above the 75 percentile many times. See more concentration of pink areas over here, right? But 2023 was a year of recovery, right? So we got a pretty nice period of a market rally. And in 2024, we had the same. We had two periods, consecutive periods of nice rally, right? Of course, they were interrupted by a few corrections here and there, um, but essentially it was a bull market. And Want to point out is this, right? If you're not using, let's say you're not using the risk 500, you have no clue, right? So you are basically here. uh, how do you know if this zigs and zags here, right, these ups and downs, is dangerous or not? I mean, is this downturn is going to turn into something that's going to cost you a lot of money, or it's just like a very brief correction or just a pullback, and the market will go back up again and follow this nice rally? How do you know if this little dip here is significant or is insignificant? It's not important. You don't, right? But the risk 500 will give you that information because it is, well, look at this, for example. This dip here could be important, could be, but the risk 500 is showing you no, it's not very important because it's the risk measured in the market is not critical. So you're good. You can just hold. You don't need to be buying and selling every day. All right. As you can see, we can stay very long periods of time, okay, like for months, just holding the position. We're just holding this position for long periods of time. We don't need to get out because we know in the long run we're gonna make money here, right? If this is not dangerous, so this downturns here is not dangerous, but this one is okay comparatively, right? So this that's why we use percentiles, because we put everything in the context of the last 15 years. The last 15 years is the database that produces the risk 500. So we measure the risk in the context of the last 15 years. And this will give us the um, the guidance that we need in the market. All right. So that's the idea behind the indicator. Okay. So again, the risk 500 indicator is a combination of multiple variables, and the volatility risk premium is just one of these variables, right? However, it is an important piece of the puzzle. Just to show you guys some others that we use, um, here, right? So the VIX cash term structure and the VIX futures term structure, volatility of volatility. So here, just you guys can see, here's the contango backwardation. This is the VVIX, the volatility of volatility, the volatility of VIX, right? And here's the VIX alone. Here's the VRP. As you can see, they all have they behave very strongly around crashes, right? That enables us, by taking information from all of them at the same time, to give us a picture of a imminent crash that's coming. All right, that's the idea. So, for example, this one is the cash term structure. Okay, so we will have a VIX 9D, VIX implied volatility for 9 days. The VIX is for 1 month. We have also the VIX 3 month, VIX 6 month, and the VIX 1 year. All right. This we're gonna talk about this in more detail at a future meeting. Okay. But today, just to give you a very basic idea what it is. All right. But you see, what's interesting is that if you compare the relationship between the VIX 90 and the VIX, or the VIX and the VIX 3 months, the VIX and the VIX 6 months, the VIX and VIX 1 year, you will see that the VIX 9D, because it's only 9 days, it moves very fast. All right, it has the the is the earliest mover is the VIX 90. So if I want to see what's going on in the market, I want to detect micro movements. That's what I wanted to see. Okay, the VIX 90 over VIX, right? The VIX over VIX 3M is also fast, but not as fast as the VIX 90 over VIX. The medium speed is the VIX over VIX 6 month, and the slow reaction is VIX over VIX 1 year. So with that, we have a pretty much a good picture of what the market is thinking, projecting in terms of risk today and into the future. All right. So that all this information is combined to make the risk 500 risk indicator. Okay. That's why it's so powerful. And where's the proof, right? We're talking about, this kind of returns. Where's the proof? I post the proof every single day. All right. On Facebook and on X. All right. I post. This is an example of a post. All right. The good thing is that here we have the date and timestamp from the platform. This one is from Facebook, right? I cannot manipulate this. I cannot go back and change this. No, that's it. I post and I post. You can just go on Facebook and follow me. You will see it every single day. I'm gonna post there exactly what I did. So if I bought or sold, held or sold, right? The risk 500 that is the guide for this decision that I made, right? What's the date and the year to date return, and also the cumulative return since January 2022. All right. So you're going to see everything here. It's very transparent. It's there. All right. It's a live track record. All right. So just to finish today, the last 15 minutes I have, but we don't need that much. Just to talk a little bit about the market. All right. So a few the studies that I found out there, I found very interesting. I share with you guys here and make a little comment on it. All right. I don't know if you guys are familiar with the Buffett indicator. Um, the Buffett indicator is the market capitalization of the stock market. In this case, is the S&P 500 divided by the country's GDP. Okay. So, how big is the market capitalization? How big is the stock exchange compared the to the GDP of the country? So, basically, um, as you can see, this is a 100-year view. It's interesting, right? It's a 100 years view of this indicator, right? So, what we are seeing here is that it's at the top. All right, it's very very high since year 20. Remember the 1929 crash, right? Right here, hit the bottom here, this line. 2000, another crash here. 2008, and then it kept going up here, and now we're at the top again. All right, so I don't know. This may suggest a correction is due, but actually, I don't care, right? Because we don't know if it's going to happen and when it's going to happen. All we know is that we have the risk 500 to guide us. So even if it happens, good, no problem. We're going to get out of the market real quick. But if not it doesn't happen, it keep going up, we're still going to make money either way. All right? I like that. Doesn't matter if it crashes, we make money. If it doesn't crash, we still make money. All right, even more. Okay. Another indication that market might be, I don't like that, it's overpriced, right? Because the concept of overpricing or something's overpriced or underpriced is very relative to what? Relative to the past or relative to the future. You don't know the future, right? It's very difficult to judge, right? You say, well, the cost of a banana is $2, right? Is this overpriced or underpriced compared to what? If you compare to yesterday or the last 10 years, yeah, maybe overpriced. But what if tomorrow it goes up to 5? Well, it's not that up to overpriced, it's underpriced. So that I don't like that kind of concept to guide me as investor. It never worked. All right. A lot of people follow that. They do valuation to guide their investments. I don't think that's a good way to do it. I measure risk and I take my decisions and make my decisions based on the risk that's measured, because that's going to give me the near term direction, and I will make my decision based on that. Okay. So, but here is the S&P 500 price to peak earnings ratio, right? using the the peak TTM operating EPS, earnings per share. Okay, trailing 12 months. Okay, TTM's trailing 12 months. Um, as you can see, it's going high, right? Getting close to what we had in the 2000s, and we all know what happened there, right? So it's another suggestion that a big correction may be near. Will it be? I don't know. And again, I don't care, right? Because we have the risk 500. We don't need to care about this. We're gonna make money either way. Okay, this is another one that's talking about the Nasdaq versus the M2 money supply in the US, right? What is the M2 money supply? It's basically liquidity. How much money is in the market, right? This is moving around in the market. If we have a lot of money there moving around, this money will end up in the stock market, right? So, um, again, if you look at what happened in the dot-com bubble in the 2000, uh, we are pretty much now at the same level, right? So those who are like, you know, predicting a doomsday, mm, it, it makes you think, right? Again, do I care? No, I don't. All right. Here is just the behavior lately. Who's buying, who's selling, right now. Looks like the uh, retail clients, maybe you and me, right? Buying. People are buying. Corporates buying. They may be buying back their own stocks, and uh, but hedge funds are also buying, net buyers. But institutional, they are selling. The big funds, they're selling, right? They're selling to these people over here, right? Okay. All right. Another place where a lot of money is being parked is money funds, right? The money market funds. They're paying like an average of 4.5%, and a lot of people are just putting money in there to get that yield, right? They're not going to the stock market, or maybe they are, but they're allocating a lot of money. They're very liquid and it's paying 4%. Is 4% good or bad? Again, it's like, well, depends on the context, right? If you know on the last 10 years, if when interest rates were very low, 4% today is pretty good, right? But I don't know, it's good or bad. Um, I'd rather use the risk 500 and put my money in the stock market. I think I get more uh, bang for my buck and in a very safe way because I have the instrument. Otherwise, I wouldn't. All right. And here is it's interesting. Gold, right? Gold has been going up crazy this year, right? Year to date, 30%, right? It's absolutely fantastic. It's been a great run. I have my gold positions, but I also use gold in the rotation in some of the strategies. I think the last three strategies, 6, 7, and 8, I use gold in the rotation when the risk 500 indicates extreme high risk. I rotate strategies 6, 7, and 8 to gold. All right, look at this. It suggests it's just broke. It just broke this line here, right? Yeah, broke the resistance. Who knows? It may go for a continued bull market here. I'm a firm believer in it. So, and also if you look at the U.S. dollar is going down. This is, I think, and the U.S. Treasuries doesn't have they don't have the same, they're not as attractive as they once were. So I think gold still have a good run for the future. I don't know. That's my opinion. Um, okay. Now, just to finish, there's a last slide about this topic. Just be careful out there. Okay. Tactical investing guided by a RISP 500 to earn each gain opportunity, but ready to sell quickly if needed. All right. So if you look at this, this is the S&P 500, right? Had a great run, the liberation date here, right? And after liberation day, we also got very small volatility increases, just a little inches, each inching, the market's inching up by little, but small steps. Um, and it's coming to a point where a lot of people, as just we said, a lot of people are thinking that we're coming to very dangerous levels. I don't know again, right? But with the risk 500, we can, um, and the studies, right, that we are with the VRP and the other things and variables that we're going to talk in the future, it helps us, you know, tactically manage our investments. All right. So if it doesn't matter, if it's going to keep going up, we're going to keep making money here. If it goes down, we're going to get out of the market. Or if you're in strategies 6, 7, and 8, you can just switch to, you're going to rotate to another asset. It could be gold. All right. Okay. So again, just to give you, if you're here for the first time, you haven't joined the club, I encourage you to do so. All right. So here, as a club member, you get special access to the risk 500 indicator, right? It will help you time the market, detect and avoid market crashes early, beat the S&P 500 every year, and truly accelerate your wealth. All right. Plus other benefits that we have over here. Okay. Just a disclaimer, right? This is not financial advice or investment advice of any kind or personalized recommendation, just general information and educational purposes only. All right. Okay, so if we end here today, I just wanted to let you guys know that next Wednesday we're gonna take a brief break. All right. Yes, and let's take a brief break, and I will see you in the following Wednesday. All right. Okay. I hope you have a great night, and see you the following Wednesday, not next, but the following Wednesday. All right. Thank you so much, and have a good night. Thank you.